In this module, we're going to talk about all things related to insurance. So as a backgrounder, let's talk about some key terminology that's used for all types of different insurance so that you have a base of understanding. The first term is just what is insurance coverage? So insurance coverage is basically an agreement between you, the insured, and an insurer that basically in exchange for you making an upfront payment, which is called the insurance premium. So this is a term that is going to be used in all the different types of insurance that we're going to talk about. So you pay upfront what's known as an insurance premium. In exchange for this payment, the insurer will cover you from losses. So I think as we talk about specific examples of this will become more clear. But basically, in the insurance coverage, you are trading basically an upfront payment, and in exchange, the insurer is going to basically protect you against losses. So a policy is a written formal contract of insurance. So the policy is going to basically set the terms of the insurance coverage. And so it will describe what perils are covered by the insurance and other terms related to the insurance agreement. So basically, the insurance policy is the formal written statement that is going to outline, all the terms of the insurance coverage. Okay, so the term deductible. So this is the amount of the loss the insured, so that's you, is responsible for to pay before the insurer pays. So, for example, if you get into a car accident and your insurance deductible is $1,000 and your car, let's say it's totaled, is $20,000 to replace, you, if the deductible is $1,000, will have to pay 1,000 of the replacement, and then the insurance company will pay the remainder. So it's a way to basically have you have skin in the game. So again, here's another example. If the deductible is 800 and if the deductible is 1,000 and your loss is 800, then the insurer will not owe you any payment because the first $1,000 of loss you are responsible for. So if the loss is only 800, then you're responsible for the entire 800. However, under the same policy, if the loss is 1,500, then the insurer would only pay 500 because again, you're responsible for the first $1,000 of this loss. And so the higher the deductible is, the less premium the insurer will charge you since you are taking more risk. So for example, in this example, if the deductible is 2,000, then for this $1,500 loss, the insurance company wouldn't owe you anything. So the higher the deductible is, the more risk you are taking, but the trade is that you will have to pay less to the insurer because you're bearing more of the risk. So that's kind of the idea of a deductible. Okay, and so the insurer is not going to just protect you to an unlimited amount. So there are policy limits. So these are basically the maximum amounts that the insurer will pay. So, for example, in health insurance, you may be paying, let's say, $100 a month. So you're paying $1,200 a year. And that $1,200 a year will protect you from health costs, but there's a maximum. So it might be $1 million or $2 million. So for that $1,200 in premium that you pay for your health insurance, you don't have unlimited coverage. It's pretty high, and it's unlikely that you're gonna hit the limit. But the insurer will only pay up to whatever it is, $1 million or $2 million per year. So the insurer in that way is capping their loss at some limit. Okay, so let's keep going. So an insurance agent. So this is a licensed and qualified expert who sells you, the consumer, insurance policies on behalf of an insurance company. So some agents work for the insurance company directly. Some agents are independent and they will offer you policies from different insurance companies, and you can kind of decide and they can guide you as to what the best policy is for your needs. So insurance contracts are pretty complicated, so especially for like commercial insurance. So having a good agent is useful. Also for life insurance, there's certain types of insurance that are pretty complicated, and it might be worthwhile to have an agent to kind of guide you through all of the nuances. So an adjuster. So let's say you have a claim. Let's say you, again, for auto insurance, you get into an accident, and you call your insurance company and you say, "Hey, like I have this damage to my car." An adjuster is a representative of the insurer of the insurance company who will come out, inspect your car, and kind of determine what the amount of loss is. And so, an adjuster, if you have property insurance and there's some damage to your house, again, an adjuster will come out, examine the damage and kind of come up with an estimate of what the damage is. Okay, so claim. So this is a request by you, the insured, to the insurance company for payment for a covered loss. So let's say you have, again, property insurance and it covers, damage to your house from a tree fall, and a tree falls on your house. Then you will have to submit what's known as a claim to your insurance company to say, hey, this tree fall, which is covered under my insurance, it's a covered loss. um, I want to basically make a claim to get paid to fix the issue. So that's kind of what a claim is. So an insurance company again will likely send an adjuster, and they will make sure that your claim is valid, and then they'll make you a payment. Underwriting. So this is a term that's used for the process that an insurance company takes to determine whether or not to issue an insurance policy to an applicant or not. So you can apply for insurance, but it's not required that the insurance company chooses to insure you. So underwriting is when the insurance company kind of examines the facts and determines if they want to take the risk to insure you or not. And also, if they do want to insure you, to determine the cost of the premium. So the more risky you may be to insure, like for example, if your house is in a wildfire area, the insurance premium is going to be higher because the risk is higher. So the insurance company, though they may choose to insure you, they're going to charge you more to do it because they're taking more risk to give you insurance. And so the underwriter is a employee of the insurance company that performs this analysis. Okay, so copay. This is a term that's usually used for health insurance, and so it's similar to a deductible, in that it's a portion that you pay out of your pocket, and again, it's mostly for medical costs, and so it's in addition to the deductible, but it's similar in the fact that it's funds that you're paying out of your own pocket. So here we give you an example. If you get an X-ray and it costs $1,000, and your copay is 20%, you will owe $200 to the insurance company, and the insurance company will pay the balance. And so typically for health insurance, there's a deductible, and there's also copays for certain things, but then there's another thing called an out-of-pocket maximum. So this is the amount that you out of pocket will pay max per year under the coverage, which includes the copay and deductible. So um, you may end up paying copay, but then once you hit the out-of-pocket maximum between what you pay for the deductible and the copay, then the insurance will cover you 100%. Oh, okay. So this is the next term. So out-of-pocket maximum. Again, this is a term that is the amount that you pay out of pocket, and once you hit this limit, the insurance will cover you 100%, as I just said. Okay, so now let's just talk about the different types of insurance that are most common, and the things that you'll most commonly have to deal with. So health insurance obviously is a very common one that people um, are gonna have to have. So I think most people will maybe already be somewhat familiar with health insurance. Auto insurance, that's something we have to have if you have a car. Property insurance, so there's two different kind of classes of property insurance. So there's homeowners insurance if you own the house, and then renters insurance. Life insurance, so this is a protection if you die, and you have dependents, people that you want to kind of take care of. You can have life insurance. Workers' compensation, also called workers' comp, is for on-the-job injuries, and it will cover kind of your healthcare costs and lost wages. Long-term care insurance is for when you're older and if you need like longer-term care, if you have, some kind of disability or disease that requires that, it's insurance that will cover that. And then umbrella liability coverage is kind of an umbrella liability coverage in excess of some other types of insurance. So we're going to kind of dive a little deeper into each of these in the subsequent videos.